How's it going out there? Hope your weeks are going well. This is Andrei Knight, and you are in Institutional Trading Strategies. How's everybody doing? Good, good. Welcome, welcome. Well, before we dig into the chart, you guys, probably the question on everybody's mind is what's going to happen tomorrow. Right? This whole week it felt like they were close to a deal, and then it would fall apart at the last minute. They'd be close to another deal, and it would fall apart again. Oops, looks like Elogate doesn't have any sound. Give me 1 second to type an answer. Oh, thank you, Drew. You beat me to it. Thank you for that. Well, you guys, is a deal still possible? Certainly it's possible. The whole thing would take maybe 5 minutes to resolve. All they have to do is put one of the proposals to a vote. Problem is, for some strange reason, John Bonner doesn't want to put it to a vote. Probably because by now, Republicans have gotten so much heat from their constituents that it would pass. That's probably his big fear. And then he'd be in the awkward position of having to stand down. Not from his position, but just from his stance. So is the deal possible? Yes, it's possible. Is it likely? I gotta say I'm losing faith. Why don't they just vote and get it over? It's political, Bista. They dug themselves so far into the ground that at this point they'd be losing face if they gave it. And there was actually a candid moment caught on tape about a week and a half ago. One of these guys was getting ready to be interviewed on CNN. He already had his microphone wired up. Cameras weren't rolling yet. And he had a quick conversation with one of his colleagues. And it was caught on tape. And he basically said, if we hold out long enough, the pressures will build and we can win this thing. So that's basically the problem. They're viewing this as a contest that they can win. Never mind the country and all the people that are suffering and waiting for them. It's become a personal contest that they're set on winning. Therein lies the problem. Misinformation, Glenn, and there's a lot of it out there. The budget that the Senate gave to the House is actually the Republican House budget. The budget that the Democrats wanted was much higher. And what a lot of people might not realize, it takes a lot of consensus for Democrats to agree on anything. It's a very splintered party. You have on one end, like, total left-wing socialists. You have on the other end, also a Democrat, a guy that wanted to shut down the Environmental Protection Agency. And then you've got all of the political views in between. So getting the Democrats to agree on anything takes a miracle. And they actually agreed to the Republican version of the budget that the Republicans are now refusing to pass because they want to attach conditions. That's why they're not voting on it. They want all the Obamacare-related conditions attached, or they won't vote. So we got ourselves a good old-fashioned Mexican standoff. It sucks. So what's going to happen if they don't agree? Is America going to fall off the fiscal cliff tomorrow? Well, I don't think it's going to be tomorrow. I've done a lot of reading and a lot of digging and consulting with some colleagues on this. The world's not going to blow up tomorrow, in all likelihood. The Treasury currently has about $30 billion left to spend, which most people's best estimates are that it should last them another 3 to 4 days. That's the spooky part, you guys. So these guys are spending $10 billion a day, give or take. How big was the Greek bailout? Not for the day, not for the year, but the whole bailout. Remember that had Europe on edge? It was 4-point-something billion dollars. The whole bailout. And America spends roughly double that in a day, just to put it in perspective. So they would have enough money to keep funding all debts, obligations, and programs estimated for about 3 to 4 days. Now, the big variable in this that I'm not sure of, does the government spend on weekends? I'm honestly not sure. So 3 to 4 days, does that put us on Wednesday, Thursday, or does that put us on Monday, Tuesday? I'm not sure. I would say we're probably safe till Monday or Tuesday for sure, and after that, we've got to be cautious. What happens after the Treasury starts running out of money is they got to start picking and choosing. Which of our bills or obligations do we pay? Which ones do we not? And that's where things start to get a little hairy. Fitch has already put America on ratings watch. Ratings downgrade watch, I should say, as of yesterday. Doesn't mean we are going to get downgraded. We were on ratings watch the last time there was a debt ceiling debate. But that watch was lifted when it looked like good negotiations and progress were being made. So there's still time to save things. But once we start not paying bills, depending which ones we're not paying, the credit rating could suffer and could start setting off a chain reaction. I'll tell you the big thing that I'm watching, you guys, and that is Treasury yields. Treasury bills are, of course, how America funds its debt. If the credit rating is called into question, if the markets get spooked, who knows? Closing the national parks spooked the markets a little bit. It depends on which debts they choose not to pay and how much that spooks the markets. But I believe the first tremors we'll see out there would be in Treasury yields because that's directly tied to America's creditworthiness. Now you can see what all the T-bills are going for at this link. Just posted it in the chat window. That gives you a daily update every morning on what the various bills are yielding in terms of interest. And if you pull that up and look at, for example, the 1 month, 3 month, even the 6 month column, you already see that they've been going up by quite a bit. When these levels start to accelerate exponentially, I would say that's when the markets are starting to freak out. And if this starts to move even more than it has already, that's where you're going to start to see some of these other instruments affected. When we reach the government shutdown, we saw a big sell-off in the Dow. As a matter of fact, we saw a big sell-off in commodities, in gold, in just about everything. But for some strange reason, the dollar actually started going up, which confused a lot of people. I got asked this a lot. Well, if people are losing faith in America, why is the dollar going up? Right? This was back here. Well, you can see it was a temporary effect. Right? It's been going sideways since then while everybody's been holding their breath. And that temporary effect is due, I believe, to the fact that people were selling everything else. They're selling stocks, they're selling commodities. The fact that the dollar went up didn't surprise me because when you sell things, well, you're converting assets into cash. That creates, at least in the short term, a demand for the cash. What surprised me last time around was that gold dropped. Usually in times of uncertainty, people flock to gold for comfort. The fact that gold also dropped kind of showed that people weren't willing to hold anything. Is the dollar going to drop this time around if there's no agreement on Thursday? It might strengthen in the very beginning, the first couple days, again, if people start dumping assets and converting them to cash, but there's actually going to be a battle between bulls and bears. Because as Americans are converting things to cash, you're going to see a lot of foreign investors, remember the dollar is used the world over, probably losing faith in the paper it's printed on and dumping it. So you got bulls in America converting assets to cash, you got bears abroad dumping the American currency. And that's going to be the struggle. Isn't it, Boyke? I think Italy might lose its crown as the most dysfunctional government in the Western world. And if we end up taking it, it would be well deserved. When politics go above people, something's up. So, first institutional tool, you guys, is a very, very simple one. Simple trend lines. And you'll notice I'm drawing these, connecting the bodies. I'm ignoring the wicks. The reason for this, for me, wicks represent price levels that were tested by the market, but then rejected. Meanwhile, wherever a close takes place, that's where buyer and seller came together and a transaction took place. They represent consensus. In other words. So when I draw trend lines, I'm not interested in the extremes that were rejected. I'm interested in consensus. A lot of what you might see today are common tools that you might have been aware of before. But what I'm going to do is show you how they should be used properly. Okay, trend lines is a biggie. A lot of people use them, but do they draw them correctly? Okay, go by the bodies. And probably on the bottom, let me see, we had a bottom here. Oops, wrong tool. One sec. Okay, why 21? I tried the 20 and the 22. Why exponential? I compared it with a simple. This one has yielded the most reliable result. We failed to find support there today. I assume at some point we will find support and we will come back up now to retest this line from underneath as resistance. At whatever point that reversal comes, that's where the second trend line should go. Okay? This is just an approximation for now. We haven't actually found support. The day's not over. But at some point, I'm sure we're going to come back up to retest the 21 as resistance. So the second trend line will adjust a little bit, but you get the idea. Draw two trend lines encompassing the majority of the price action. This has been the normal trading zone throughout this standoff, throughout this crisis. If we're still bouncing around within this zone, then the markets are in normal trading mode and they're not freaking out or panicking. We get out of this zone, we retest it from the other side, now you know another move has happened. And if we're in this zone down here, then we're seeing what we saw when the shutdown was announced. The dollar is gaining because people are selling everything else. And if we find ourselves in this zone up here, then we'll know the rest of the world is dumping the dollar. So you see, there's a lot of what-ifs up in the air. A lot of gray areas. But by using simple tool, and all I did was put two lines on my chart. But we already have a very clear way to determine what the mood of the market is. And that's what we're after. Are people dumping the dollar? Are people buying the dollar? Or are they not reacting to the situation as of yet? You can set up very simple conditional tests to answer the question. Thank you for the update, Tim Bernard. I feel bad for Speaker Bonner. That's probably why he's been avoiding putting this thing to a vote. But hey, if we can avert default, that would be great. Let's see if he follows through. There's been a lot of promises made the last 2 weeks that weren't followed through. But I hope he does the right thing. He backed the wrong horse. That's what happened. And sometimes a decision like that can affect one's career. And by the way, just so you guys know, I'm not trying to get political on you. I'm not saying anything pro-Democratic or pro-Republican. I see myself in the center. The problem is, there's a lot of Republicans that disagree with this. It's just one extreme faction, the Tea Party, which at last estimate represents just under 20% of America, that somehow hijacked and seized control of this whole thing. And as bad as I feel for Speaker Bonner, if he does end up losing his position over this, it was his decision to back the extremist minority instead of the general population. And it was his decision to back one faction over even the entirety of his party. Sometimes bad decisions carry consequences. I'm glad, Glenn, at least they're talking. Right? Whichever side of the debate you fall on, at least they're talking. Government is supposed to get done. through debate and negotiation. Not through shutdowns. Yuri, you had a question. Do I decide which way the market is going based on the 21 EMA? And then you asked about a couple different time frames. The 21 is part of the decision. No one indicator, and I'll go through all of these in just a moment, so you guys know what they are and how I use them. No one indicator is more or less important than any other. So my decision about which way the market is going, Yuri, is based on the whole chart. Okay, it's based on the context and the big picture. The 21 is part of that decision. Okay, but it's not the entirety of that decision. But certainly, one of the things I take into consideration is the 21 aiming up? Is it going sideways or is it going down? Another thing I take into consideration, are we above it or below it? If we're above it, are we moving towards it? Or did we bounce off of it and are we moving away from it? And same thing if we're underneath it. Okay, so it's part of the decision. And then I compare it with everything else on my chart to get the complete picture. As far as multiple time frames, I use the 21 in all of my time frames. Actually, the indicators don't change from time frame to time frame. They also don't change from instrument to instrument. Part of the reason I use the ones I do, Yuri, is that they are all time frame dependent because of how they're calculated. On a daily chart, the 21 measures 21 days, right? On an hourly chart, it measures 21 hours. On a 1-minute chart, it measures 21 minutes. So in other words, it's an indicator that scales automatically. And all of these pretty much are. Wouldn't it be a hassle if you had to change indicators every time you change time frames or change to a different currency pair? So I went through a lot of trial and error over a lot of years to really come up with a combination of stuff that I could use on any time frame and on any instrument. I trade stocks the same way. I trade gold and commodities exactly the same way. What changes, Yuri, is the question that I'm attempting to answer on each time frame. Okay, therein lies the key. The way I usually do my analysis, I start out every week looking at my weekly charts. I just see where I am in the big picture. Am I in an uptrend? Am I in a downtrend? Going on based on the prior highs and the prior lows? Am I closer to the beginning or closer to the end of that trend? You know, just kind of orientate myself in the big picture. Every morning, I look at my daily chart. Makes sense, right? Daily chart, new day of trading. So every morning, I review my key levels from the weekly chart and figure out how close or how far I am from them. Then I look at my daily chart and I try to understand the support and resistance levels that are relevant for today. You know, part of that decision could be these trend lines. I know where the expected top is. Part of that decision can be the 21. I know where support is expected. And if we're under that level, then I know what we need to retest as resistance. By the way, remember what I said at the beginning of class? I expect to find some support here. And before the end of the day, I expect to retest the 21 from underneath as resistance. Look what's been happening as we've been talking. Okay? So I figure out the key levels for today. Then I'll zoom into my 4-hour chart, Yuri. And as you might have guessed, I look at this minimum once every 4 hours. I personally like to refresh every hour. Never hurts to take an extra glance. and just refamiliarize yourself with what's going on. 4-hour chart, I use the same indicators, but the question now becomes, what direction is the predominant trend? Are we going up? Are we going down? Or are we chopping sideways? Don't forget there's a third option. Right? It's not just two choices, it's three. Up, down, or sideways. So, think about it. We have an approximate top. We've got an approximate bottom. And I picked this just based on the prior low. Right? And now we know where we are within this boundary. I call it the window of opportunity. We go down to the 4-hour chart. We establish the current direction. There's two prior bottoms here. And here's that daily 21, by the way. A little bit faded in the back so you can see where we are. Okay, we have two prior bottoms here. And you can see stochastics might cross, we'll know on the open of the last candle. But up to this point, they've been bullish. I haven't explained these indicators yet. I should probably go through them real quick. What I've got under my chart, I've got an OSMA. Have a good one, Glenn. If this one isn't, there are others. Okay, just go to my profile on the FX Street page. There should be others that explain these indicators. And I've also got a page on YouTube. Just look up FX Knight. Okay, that'll have some videos for you as well. And my website is fxknight.com. A lot of educational resources on there as well that you can take a look at. Okay, so what's under this chart, you guys? I've got OSMA, which is a momentum or trend following indicator. Most indicators fall into one of two groups, you guys. Momentum-based, like OSMA, like MACD. You'll notice I even use the same setting as the default for MACD, 12.26.9. Okay, momentum-based indicators. The other group is called oscillators because they oscillate back and forth between 2 points. In the case of stochastics, it's 20 and 80. You could just as easily substitute an RSI here. You just change the levels to 30 and 70. You could use a CCI, commodity channel indicator. Then the levels become negative 300, positive 300, but the way you use it is exactly the same. This is what nobody ever talks about in all those forum debates where they argue which indicator is the best one. Most indicators will fall into one of these two groups. And there's no such thing as a best indicator. There's different market conditions. Sometimes you need a momentum-based indicator, and in some situations you need an oscillating indicator. But there is no best indicator. I could stick a MACD in here. I could stick an RSI in here. Heck, I could change this color to purple, and the indicators would work just as well. It's more about understanding what the market is doing and what the indicators are telling you, more so than how to use any one indicator in particular, you guys. Okay? So know which group your indicator falls into. Is it an oscillator or is it momentum-based? The different conditions you would use them in, if the market is trending, you're obviously concerned about momentum. Is the trend accelerating or decelerating? Right? That makes sense. If the market is ranging, obviously the biggest concern is are you in a bearish or a bullish phase of that range? See how it works? And you'll notice there's times where the stochastics kind of start braiding around each other, right? Not really telling anything meaningful. But look, at exactly those times, you got a nice even slope on your momentum indicator. Same thing here. So you see when one indicator fails, the other takes over, and vice versa. Don't really see it on this chart. Now, here's a good example where Ozma starts failing. Either the bars get really small or you get a zebra pattern. Each bar is a different color than the bar before. But look at your stochastics. Exactly during this time, they give you a nice even slope that helps you pinpoint, despite all the noise in the price action, exactly where the turnaround point happens and the bottom happens. See that? Even though the momentum indicator is chopping for all intents and purposes. So when one fails, the other takes over. You've probably encountered this frustration. You read about some indicator, you fall in love with it, it's working great, and suddenly it either stops working or misleads you into some trades you later regret. And you're like, oh, screw this indicator. It's broken. It's not as reliable as I thought. No, it's not the indicator. It's that market conditions change, and it's temporarily time for a different indicator designed to work in those market conditions. I have yet to encounter, and I've been trading for almost 20 years, I've yet to encounter such a thing as one indicator that works all the time. It's about combinations so that one can, assuming they're from two different groups. Keep in mind, you got to know which group your indicator falls into. But it's about having the right combination so that one can take over when the other one fails, which it will inevitably. Market conditions change. Okay? So, trending markets, use something based on momentum. Ranging markets, use an indicator from the oscillating group. What I have in the middle is ADX. And ADX actually falls into the momentum group, FYI. Okay, there's two lines on here that I've grayed out. But if I make the positive DI green, and I make the negative DI red, you're going to notice something peculiar. Whenever Ozma's giving me red bars, the red line will be on top. Whenever Ozma's giving me green line, the green bar will be on top. Whenever the bars are getting taller, these two lines will get further apart. Whenever the bars are getting shorter, these two bars get closer together. So guess what? ADX is a momentum-based indicator. It'll tell you exactly the same thing as the Ozma or as the MACD. It's part of the momentum group. It just displays it in a slightly different way. But the way I use the ADX is a little different. I gray out both of these lines. And I just focus on the average line, this blue one here. Default setting, once again, 14. And I've put a cutoff line, a horizontal line, at 30. And what the average line of ADX measures is basically strength. Okay, the strength of the trend, or the strength of the move. And very simply, if your strength is less than 30, probably you don't have enough strength to break through support or resistance levels. Look, here we rejected 30, and we got stopped by our moving average. Right? If I back the chart up, let's find some time when we were above 30. Let's find where we were up there for a prolonged period. Here's a good point, okay? Here we've got a strength greater than 30. We come up against our 200 moving average, and guess what? We don't find resistance, we break through it. You see what I'm getting at? Strength less than 30, you're probably not going to have enough strength to break through. And well, when you bounce back and forth between two levels, we call that a range, right? When ADX is under 30 and you're in a range, use the oscillating indicator. When ADX is over 30, you've probably got enough strength to break resistance or support. And well, when you make higher highs or you make lower lows, we call that a trend, don't we? And when you're in a trend, when ADX is above 30, you use the momentum-based indicator. Well, Drew, momentum is whether you're accelerating or decelerating, moving faster or slower. Strength is how much strength there is to a move. They're two different things. Let me give you an example with cars. Okay? You can have a little plastic Daewoo, and you can have a semi-truck, right? Both can go 10 miles an hour. Both can go 60 miles an hour. Both can accelerate, both can decelerate. That's momentum. If they hit a brick wall, probably the semi is going to hit it with a little more force. Whether they're going at 10 miles an hour or 60, right? Probably the semi would do more damage to the wall than the Daewoo, even given the same speed. Okay? So think of the vehicle as your price action. Think of the brick wall as support resistance. Does that help out? Momentum is whether you're accelerating or decelerating. Strength is how much force you're going to hit any support resistance level with along the way. When ADX is over 30, it is a momentum indicator if I turn on the positive DI and negative DI lines. But I'm not using those two lines. I'm using this third line. See what I mean? It's a momentum indicator if I turn on the tools that you would normally use with ADX. But if I do that, I don't really need the Osmo. It becomes redundant. I personally like the Osmo because when I have 10 charts up on my screen, it's much easier to see whether the trend's accelerating or decelerating based on these big bars, than by squinting your eyes and looking at the little lines. So it would serve the same function as Osmo using these two lines, the positive DI, negative DI. But I'm not using those. I'm just using the average line, and the average line measures strength. Over 30, support resistance levels will likely break, and I'm in a trend. Under 30, support resistance levels will likely bounce, and I'm in a range and using the oscillator. Okay, think of it as an indicator selector. You could probably just look at a chart, determine is it going up, down, or sideways, but this gives me a way to quantify it so I don't have to guess. Okay, so that's what we're looking at on this chart. Now let's put it in the context of what we've been discussing. ADX is under 30, right? So we're in a range. We expect support will hold. Doesn't always work 100%, but that's our best expectation as of now with all the information we have at our disposal. We expect support to hold, which it looks like it did for the third time. Furthermore, because we're under 30, we want to go by the Osmo. We want to go by the stochastics. And if we look at the stochastics, the green is over the red. So remember, 4 hours, 4 direction. Put all this together, what do you got? Despite this red candle, the overwhelming direction is still bullish, despite the red candle, and I expect support will hold. In other words, direction is sideways. Okay? Same indicators as the daily chart. I'm answering a different question. If we were down here and the indicators would all be strongly bearish, if this cross had been successful, a touch is not a cross, by the way. Okay? And you can see we're slowly opening back up. But had this cross been successful, had we stayed below this line, then I would say direction is bearish, and then I would go to my 1 hour chart and look for a bearish entry. Okay, so weekly chart, big picture. Daily chart, the key level or the window of opportunity for today. Where's the nearby support resistance? 4 hour chart, what is the current direction relative to those nearby support resistance levels? And then, armed with all that information, I go to the 1 hour chart and I look for an entry signal at the top of each hour in that direction. If the stochastics had crossed to bearish and we had an hourly open down here, it would make absolutely no sense to take a bullish entry, no matter how tempting it might look on the hourly chart. You see what I've just done? I've eliminated all my options until there is one good one left. Unlike a trading robot, I'm not taking every entry signal that meets the criteria that happens to come along. I'm looking for one specific entry signal. And either I get it or I don't, and I keep waiting. You see the difference? Or most beginning traders, half of them aren't even using a system or aren't using the system right. No wonder 95% of traders lose. I understand it's more fun to trade than it is to read a book, right? They're eager to just dive in there and pull the trigger. And unfortunately, all too often, they pay the price. Some of the ones that take the time to learn a system end up trading just like a trading robot. Something twitches up, they buy it. Something twitches down, they sell it. And their trading is all over the place. I'm not looking for just any entry signal. By the time I finished my top-down analysis, I'm looking for one specific entry signal. Just one. And either I get it or I keep waiting. Now, I'm allowed to change direction. Don't get me wrong. You don't have to be a bull or a bear the whole day long. But I'll make that decision to change direction based on what I'm seeing on the 4-hour chart, not on the 1-hour chart. And then I go back to the 1-hour chart, keep looking for entries in that direction. So see, it's about narrowing your options down till the only one you're left with is, in most cases, nothing works 100% in trading, but much more often than not, the one you're left with is the right one. And you either get it or you don't. You either get the criteria or you don't. So let me go back to the daily here and let's talk about what we expect to happen. And that's not uncommon, John, by the way. Well, keep in mind the candle's not closed, okay? This is another important point. Don't make your decisions mid-candle. You might not realize it, but it's akin to using no trading system at all. You might think you're using a trading system because you just spent half an hour poring over your analysis. Right? I did my work. I'm using the system. Now, if you execute mid-candle, and that goes for exits as well as entries, you're not using a trading system at all, no matter how much analysis you did. Because whatever you used for your analysis, such as, the cross, before the candle closes, it could just as easily uncross. See what I mean? Anything you use to justify your decision is temporary until the candle actually closes and prints that way. And there's also discrepancy, between brokers. What is the start and end of a day? in a 24-hour market. You know, it's easy with stock markets. They have a definite opening and closing time. What's the open and close of a 24-hour market? Well, you might say, oh, that's easy, midnight. Okay, midnight Hong Kong time, midnight London time, midnight New York time. New York actually doesn't even use midnight. They use 5 p.m., the close of the market. You see what I mean? So there's a lot of discrepancy from country to country in what midnight is and what the official start and end of a worldwide 24-hour market actually is. And if midnight's different, well, guess what? 4 a.m. is going to be different from broker to broker. 8 a.m. is going to be different from broker to broker, right? So that's part of why I use the time frames the way I use them, John. 4 hour is for direction. It's not for pinpointing the specific timing of your entry. Therefore, that discrepancy isn't going to affect you as much. Meanwhile, the 1 hour chart where I actually make my decisions to get in, get out, stay in, or stay out, right? I make that decision at the top of every hour. And if anything goofy happens during the hour, well, I know when the economic reports are scheduled. You can get those right at fxnight.com. It's on our homepage. Just scroll halfway down. I know when the economic reports are, and during those times, I'm going to be watching the markets much more closely. You know, if I'm actually trading the news, I'll probably be on my 5-minute chart, so I don't have to wait for the next hourly open. But news events aside, if something wacky happens during the hour, that's what your stop and target are for. And if you're a professional trader, you never enter a trade without knowing where your stop and target is going. Okay, so I'm covered. If something happens during that hour, and price can hit my stop or my target without my help. I don't have to watch it. I don't have to nurse it along. I found with a lot of people I train, the less they watch the chart, the more consistent the results become. It's when you feel you have to nurse it, confirm it, and reassure it, and never take your eye off of it, that's when you get tempted with all those reasons that feel good at the time, and then you regret later to violate your trading rules. The less you watch your charts, the less tempted you will be. I open up my charts once an hour. I go through my 4-hour, 1-hour analysis, and I answer the question, get in, get out, stay out. And then I minimize my chart for another hour. I don't care. My stops and targets will do their job. Okay, sometimes you got to manage a trade. You got to adjust it. You might have to exit a little early ahead of target because there's an unexpected reversal. That's what the top of the hour evaluation is for. Okay, but mid-candle, I don't trust it. I trust my stop and my target during that time. And seriously, you guys, if you've been struggling, try making your decisions on candle open only. Try to avoid looking at the chart in between. Amazingly, you'll find the less you look at the chart, the more accurate and consistent your results become. It's all this back and forth twitching that tends to make us nervous and compels us to make decisions we later regret. And that's correct, John Savage. I take a 1-hour trade in the direction of the 4-hour. Correct. Increasing my chances. Right? And also within the context of the daily chart, the nearby support resistance level. Remember, it was because of the daily that we expected there might be a bounce here. And then we confirmed that behavior with what the 4-hour chart was doing, or in this case, not doing. It failed to cross the bearish. It'd be very different if we were under this line and all our indicators turned bearish. See what I mean? So yeah, I take entries given the context of the daily chart and the direction of the 4-hour chart. I reduce all my options till the only ones I'm left with are the good ones or the most likely ones. Right? The most likely to succeed. That's the idea. Boyke, you were wondering, how do I choose which pairs to trade? Basically based on this. Once you practice this, it's not going to take very long. It takes me a minute, maybe up to 2 minutes per pair. Okay, so very quickly, candle opens, I can go through 5, 10 pairs. I take the ones that have the most compelling setup. Now keep in mind, Boyke, it's not that I evaluate all 10 pairs once every hour. Half of them are going to look wishy-washy and inconclusive from the daily chart. If there's no clear scenario on the daily chart, there's no reason to look at the 4-hour chart. From the 5 or 6 that are left, a good half of them are going to look wishy-washy on the 4-hour chart and have no clear direction. Well, there's no reason to look at those for another 4 hours. So that will usually leave me with about 2 to 4 pairs that I'm checking at the open of every hour. See what I mean? And then I go with the one or ones that have the most compelling entry on the 1-hour chart that fits with the 4-hour direction and the daily scenario. And then in another 4 hours, the pairs I'm following might change if one of the other 4-hour charts starts looking more compelling. And on a new day, the ones that looked wishy-washy for the day before might suddenly look tempting. So it all stems from that top-down approach. Once I see a clear direction, Gabriel, that's correct. Okay? And remember, that direction can be sideways. Okay? You can see, for example, here, we're in a sideways direction. Oh, sorry, that's the daily. But we're in a sideways direction. For the most part, we're bouncing back and forth between these two levels. Well, you can still trade this. Since your direction sideways, you're in the range, you can trade it using your stochastics. Here's a doji, for example. We didn't even make it up to the top of this line. The bounces that happen here, well, they're easy. They're no-brainers. Or down here. But look at this. We start out with a long body. It's getting smaller, smaller, smaller. Wicks are getting longer. We get a doji. We open below the cross of the doji. ADX is slipping below 30, so I got to use my stochastics. Stochastics have already flipped red over green. It is okay to take this short, even though we haven't reached all the way up here yet. See what I mean? I'm not leading with the indicator, mind you. I'm not going short because the stochastics cross. Indicators are lagging, that's true. Price has to move first, then your trading platform performs some calculation and voodoo on it, and then the indicator is displayed. So yeah, indicators are lagging, that's true. The good news is, computers are pretty good at math. Those calculations usually take milliseconds. But still, I'm not going to lead with a lagging indicator. I make the decision based on price. Then I confirm with whichever indicator ADX is favoring to get a go or no go. If this looks tempting but the indicator disagrees, I wait. Okay? And by the way, it doesn't mean when everything doesn't line up that you have to give up on your trade idea. It just means the timing isn't quite right yet. Okay? You can still execute that trade idea, just maybe later. So, price action is what compels me to make a move. Whichever indicator ADX is favoring, confirming it, is what gives me the green light. See what I mean? I'm not entering just because the stochastics cross. I'm entering because they're already bearish when price action gives me a potential setup. How many trades do I take in a month? I mean, I can tell you I take on average, most of the time, 2 to 3 a day. On a busy day, I might take 4 or 5. On a slow day, I might take 0 or 1. But an average 2 to 3 trades a day. Keep in mind, though, once everything lines up, it's very different from scalping away on a 1 minute or 5 minute chart, Gabriel, where your typical trades are, 10, 20, maybe 30 pips at a time. When everything lines up and I get a go, these are unusual circumstances, right? We're waiting to find out if America is going to fall apart or not. Markets are understandably nervous. But under most normal conditions, here we break the trend line. ADX comes up above 30 to indicate we've got an emerging trend. OSMA's dropping, volume's rising. This is a great setup. That's 77 pips. And that's a small trade, Gabriel, because we're in a choppy market. If we're in a trending market, it's not unusual to using this system to rack up 100 to 150 pips per trade. So you nail 2 to 3 of those a day, 10 to 15 of them a week, you're going to be a very happy man. We're at the end of the hour. Let me give you guys a couple links to go forward. First, this is how you can reach me online, my Twitter, my Facebook. The top link is a newspaper we publish every morning at 8 GMT. It's just a summary of the most trending financial headlines across like Facebook, Twitter, Google, etc. Right? The idea is if that's the most read story, that's probably the one the other market participants are reacting to. So we measure how much each one is read to evaluate its relative importance. So kind of a daily newspaper you can start your day with. The second link, I've covered all the indicators I use and how I use them, most of them. We didn't get to fibs or pivots today, but most of the ones I use in daily trading. If you want to go deeper and get really in depth into each one, why we use it that way, so forth, as well as a good dose of money management, trading psychology, risk-reward ratios, all that stuff most other trading systems leave out, we've got all of our best workshops recorded for you. You can watch them at your convenience. That's the second link. No classes, no scheduling. You do it when you want. Third link, if you found today useful, we've got what we call the Pro Room. We do this every single day, twice a day. We meet for an hour when markets are opening in Europe and discuss the potential setups for the day and what it would take to trigger them. And that's where we diverge from most other trading programs. Because then I turn my students loose and let them execute those scenarios and setups on their own instead of me spoon-feeding them. You don't learn anything when you're spoon-fed. You just become dependent on some guru that you're going to miss when you can't afford them anymore. So I do the setups and I explain why they're setups and what we're looking for. And in the process, you learn hands-on how to use the system. But then I turn you loose to trade for a couple hours on your own to see how well you execute those setups. And then we meet for a second class at the end of the day and we evaluate how you did. What worked well and should be repeated. What didn't work quite so well and should be tweaked for the next day. And we do that every trading day, twice a day. Pretty cool, huh? You thought an hour together was helpful. Try that for a couple months. And then the third link, if you're on a budget, either low on money or low on time, third link is what we call our weekly video update. We just send you a recording of the Monday morning sessions from each week. You don't get to interact, you don't get to ask questions, but hey, it's the budget program. But what you do get is you get all of the scenarios and potential setups we're watching for the week ahead, summed up in 1 hour-long concise summary. And stop by fxnight.com, you guys, even if you're not interested in training. We've got a lot of free resources on there just to help traders out. Economic calendars, interactive charts, videos, free forum, free chat room. What I basically did is I noticed that I was visiting half a dozen websites every morning to start my trading day. And what I tried to do was put all the information in one place. That's basically the idea. And at the very minimum, sign up for our mailing list while you're there. We're not going to spam you. We send out 1, maybe 2 mailings a month. And basically, it's usually to invite you to another free webinar like this one when we've got one coming up. So thank you very much for your time and attention. I hope this was helpful. And I will see you a week from Friday for our next Fibonacci Friday session. Take care, you guys. Let's hope we don't go off the fiscal cliff, right?